Okay. Well, N Jayakumar joins us now. Let's take a conversation forward. Before we talk about what is the way forward, I'll have to take the clock back and discuss and understand from him what happened yesterday. Jake, good morning. Thank you for joining us. Jake, in the overall scheme of things, how much importance would you pay to yesterday's sell-off? Just a one-day, scary, more like a horror, more like a Hindi movie with a bad ending, or you would say that, look, the sequel has changed?
Changed at all. My own assessment is that whenever markets get into these year-end kind of situations where participation is low, as evidenced by FII and local activity as well, and where in the short run, a lot of HNIs, a lot of traders have jumped onto the bandwagon, which is really what was evidenced. If you see the last 8 to 10 sessions, you've had a rise every single day, every dip was bought. And these kind of things tend to shake people out quickly. And I think it's not a bad thing. It's exactly what markets do, and especially markets that seem to be stretched in the short run, where traders and HNIs are here for the quick scalping kind of trade rather than an investing trade. If you see, mutual funds have been sellers, locals have been skeptical. But given the trend, people are trying to see if they can make a quick buck. And when that reverses, logically and correctly, it results in this kind of an upheaval in terms of the unwind trade. Everybody rushing to the exit. It'll take a day and a half for those trades to get cleared out. And then I suspect the markets will, maybe from 13,100, but maximum 12,800 as I can see. But 13,100, 13,150, it'll start its move again. Please understand that locals have been extremely skeptical in this. So yesterday was a classic case where institutions didn't participate that much, but it was HNIs and traders whose positions got sold and busted.
Jakes, typically when you see a sell-off like this, and you know it more than anyone else, that best of the bull markets, they give you some scary moments. What happens is it changes and shakes the leadership and the underlying current in the market. Do you think what we've seen yesterday is capable of changing the market orientation, let's say back to some sectors or back to some outperformers?
Well, I'll tell you, I think the overall setting for equity markets could not be better as of now. And yet, public has not participated. So their short-term nervousness is clearly coming through. I think the fundamental underpinnings of this, which is low interest rates, high liquidity, fiscal incentives across the board in the world, are very, very, very much still intact, number one. Number two, you dovetail this with India-specific measures, and we are all said and done close to a vaccine in some form or the other coming through. Already parts of the world have started getting the treatment. So I, for one, believe that we need to take a slightly longer term view. We will go back in history and say that the move that happened in March was like the flash crash. And if you see, compare current levels vis-a-vis, let us say, Jan, Feb, March or Jan, Feb, today we are what, about 6-8% higher? That's it. So it's not the end of the world. 12,200-300 we were even in January, February. From then to 13,300 or 400 is you're about 7 to 8% higher. It's not the end of the world. And if you see this in the context of what I think is a coordinated action worldwide for a revival, certainly in the Indian markets, in that context, the flash crash as kind of situation in March will be what history will see it as. That was one big crash. It lasted over a 20-day period. And then the recovery happened from 7.5, 8 that it touched all the way to where we are today. So it was like the spring being compressed. People who overbought in the market, markets are crying for a correction. People pressed the spring too hard, and then it just bounced back once people's trades had been squared off.
Jakes, for those who are looking at valuations, there are enough and more strategists and research heads. They are coming up with calculations which indicate that markets are trading way above the historical averages, and that is unlikely to sustain. What is your counterpoint to that?
Is that we've never had a scenario where a zero to near zero interest rates to no interest rates, negative in most parts of the world, continue for as long as they are. Therefore, the holding cost of equity and the attendant return expectations and periods of return over which you will, periods of time over which you will expect these returns, that's got extended. So the return expectations have dropped. Where you were expecting a stock to double in say 3 years or 3.5 years, now you don't even mind holding for 5 years because what are the options that you have? So there is a flip side to this, and I don't think it's as simple as saying simply because we are at higher than historical averages. We've never been as low, and in the scenario of a weakening dollar, the dollar index has gone below 90, and I think it's headed a lot lower. So given this kind of a scenario, where in the world people are moving to things like Bitcoin, gold was in fancy for the last 2.5 years. Now people have moved to the cryptocurrencies. So money is looking to find new avenues. And in that context, when you say that vis-a-vis a China, which seems to be everyone's favorite whipping boy in a sense, at least in actionable sense, multinationals are moving their manufacturing and sourcing out from that country. And as this is being redistributed in different parts of the world, I think India will end up becoming, if nothing else, a default beneficiary, number one, and more importantly, a beneficiary because by choice with PLI, etc. here, I think the manufacturing sector could well turn out to be what technology was in early 90s. We could have a 10 to 20 year bull run in manufacturing, engineering, both domestic and MNCs operating in India in the engineering and manufacturing spaces. And that's a space that I think is still quoting at pretty reasonable multiples, especially Indian engineering companies. Some of the MNCs are still trading at MNC premium. I see a lot of action in terms of MNCs wanting to delist their stocks from the Indian markets in terms of bringing in more technology with higher ownership. I see Indian companies, operating at capacities which are close to 100% and expanding capacities, something not seen for the last 35 years in India.
Okay. So in light of that, Jakes, what you're actually saying is that you would continue to buy in on these dips, particularly, I mean, what comes up for me is the metals, the commodities pocket, which we've been seeing traction on. You continue to sound confident on that, not shaken by some of the news flow yesterday.
Well, market moves we've seen like this several times. I mean, when the markets were going up, the naysayers were aplenty. Now, a one-day correction, to my mind, does not a summer make. I think we've seen corrections of this kind, and I'm not fazed by what happened yesterday. Is it a reversal? Frankly, I don't think so. In any case, a one-day move doesn't, portend to a reversal. And I think as long as the global setting remains between the various factors that we talked about, I don't believe there is a problem in the markets.
Okay, and in terms of domestic triggers then, what will you be watching out for? What's going to be next on your radar? Would it be earnings, the budget? Are there any major expectations from the budget?
Well, the earnings cycle upgrade is clearly on. We just don't know how much these earnings will move up. Let me give you a snapshot of what's happened in the first 6 months. We're into Q3 as we speak. In the first 6 months, most companies, especially if you compare Q2 over Q1, have shown turnovers that are flat or even lower. But importantly, EBITDA on an absolute basis and EBITDA margins have gone up substantially, which means that the Indian corporate sector has gone in for all kinds of cost cuts, for all kinds of austerity measures, and that's coming through. One of the fallouts of this could well be joblessness, which then has to get redistributed into other sectors, maybe into the e-commerce space, maybe into the digital space. But the reality is, there is substantial efficiencies that have come through. Now, if Q3 and Q4 show that the turnover actually moves up compared to what Q2 and Q1 were, certainly in comparison to Q1, because for most people Q1 was lost. In comparison to Q2, you will have a step up in turnover in Q3 and Q4. With those efficiencies near permanent baked in, you will have very strong EBITDA growth. And that begins a virtuous cycle in terms of the earnings upgrade. So a number of things that we are seeing today in terms of multiples may not prove to be as expensive, especially if you see earnings that could come through and I think the earnings for the next 2 quarters could surprise dramatically. I can see companies, even a company like Prime Securities, which is purely in the advisory space, first 6-9 months, travel costs virtually zero, entertainment zero, light, heat, water, electricity in the office zero. We're operating from home, and so on and so forth. Transportation, all kinds of things. So there's been savings on across a whole bunch of things. And what have we invested in? Back into technology. So some of the spaces that become beneficiaries of this kind of a permanent change, even if the vaccine were to come out, the fact that most of us have seen a quality of life improvement of the kind that we have over the last 6-9 months, and ways of working have improved, efficiencies have gone up. The typical 2 hours back and forth travel for most staff in Bombay and in other cities is not there. I think we're going to see this as a permanent way to continue. And it's already happening across the world. Google's already announced, for instance, a near permanent work from home, except 2 to 3 days a week in office if you require it, etc., etc. So I think efficiencies have come out. This efficiencies got moved, translated back into things like maybe, apart from technology, maybe into pharma, in terms of higher spending, insurance, and those kind of things. So I personally believe that, and a collateral sort of beneficiary of this could even be the real estate space. As smaller houses in suburban areas, demand is moving up as people want to now actually create places where they can work from closer to home. And that's going to be the way forward. So I see a lot of beneficiaries, and, a single day fall in the market, in retrospect may well turn out to be a good time to, go back in to the extent that people are underinvested.
Right. Jakes, last when we were chatting with you, that was in the month of October, I remember you were making a case for PSUs. You said that they are undervalued, SBI is the best in the banking space, but you also talked about as to how disinvestment has only been eroding value, and then you were putting a case for debentures. The disinvestment theme has sure picked up, so have PSU stocks. Where is it that you now stand within PSUs? Because as of this morning as well, Shipping Corp of India, the EOIs have been invited for February 13th.
So the way I see this is, and this is a case that we made out even when we put out our paper from Prime Securities on case for bonus debentures by the government, by government-owned companies. The point we were making was that portfolio sell-off, 2%, 3% sell-off in the PSU basket has only eroded value. I think the government has seen this point. If you see even the message that has been sent out to various PSUs is, tell us what more you can do with the balance sheet, whether in terms of buyback, whether in terms of higher dividends, and more importantly, continuing investments, because they have to carry the investment can, considering the private sector is not that investment friendly today. In that context, you've seen steps being taken by a number of people. The only sell-off that the government should actually be doing is strategic divestment, which means either a complete sell-off to a strategic buyer, or you try and improve what you can do from the balance sheet. And I'm fairly confident that even as we speak, the PSU bonus debenture idea is being discussed. There's a lot of conversations that have been happening with MOF folks, because it's a better way to harness the unleveraged characteristic of the balance sheet, where you can actually use the underleverage there to distribute bonus debentures, both to the government, which is on an average 60 to 70% owner in most of these public sector undertakings, and the public. So a higher payout, no portfolio piecemeal disposal of equity, and strategic calls on divestment. I think clearly just the rhetoric itself has moved the basket of PSU stocks up. And I have no reason to believe that if the government continues, because now they've tasted blood of how a re-rating can happen, which ultimately only helps them more than anybody else. I have no reasons to believe this will not continue. And I think this may well be the first time. So 2 baskets at that stage, if you remember, the unloved, almost hated sectors, PSUs and the banking space. The PSU basket was another, PSU banking space was another case, where a number of cases of much lower provisioning, no large-scale provisioning, no retail delinquencies, means that these balance sheets have today, and with some of them have also raised capital like Canara Bank, PNB, IDBI, Central Bank, etc. So I think on the whole, the banking system is much more well geared. There is zero interference in decision making largely, and some of these are, most of these are extremely well funded in terms of liquidity, and therefore can actually grow that much better. So growth in the banking space is a big catalyst for any kind of a investment cycle that you want to recreate. I have no doubt, even with the PLI, even the private sector will step in to help or buttress the PSU efforts. So I have no doubt that the investment cycle is there ready to be kickstarted, and there is no reason to be negative. In fact, I think we could really be surprised in terms of the extent and the length of the bull market.
Sure. Much like PSUs, Jakes, is there any pocket that you would be a little wary of purely because of the news flow now coming in from UK? Maybe globally linked sectors like metals, or do you think they're still very much intact with the move?
I think you need to always be cautious. I think the biggest caution that we can exercise is if there is a significant fear of inflation that we get to see, which is not the case today. If you don't see that, is there a particular reason why central banks, fearing, for instance, the weakness of the dollar, may decide, especially in the US, that they must tighten this easy money policy? That could be any time those kind of macros kick in, I think would be a problem. I think the other thing that's benefiting India is there's a big shift in the emerging market, in the developed market theme, where people are moving money from developed markets to emerging markets. That becomes the other source where the Indian markets are beneficiaries. So whether it's the DM to EM, diversion in capital flows, or the other macros that we talked about, there is nothing right now on the horizon which indicates that you need to get scared, other than a run which has caught people completely off guard. And the size and extent of the run has been breathtaking. There will be pauses on the way, there will be corrections. But to take a 2-year view, I have no reasons that people shouldn't be looking at equities as the asset class to make the most amount of money.
Markets are clearly saying that we still want to go for the best. Kotak is at an all-time high, HDFC Bank at an all-time high, Bajaj Finance at an all-time high. SBI is not at an all-time high, Axis Bank is not at an all-time high, and I'm not even getting into IndusInd Bank, RBL and other banks. So what are markets telling you?
So I can only say, typically we don't talk stocks, but just to make a disclosure, because sometimes you need to mention a name or two, and some of these, will be there in my personal portfolio. From a prime securities portfolio, we don't hold stocks really. So, we don't trade, we don't hold stocks. It's purely advisory. So that's not a conflict there. But something like an SBI, I think could be, will be bought literally on every dip. And there's no reason that the market cap is where it is today. I think it can be easily 2x from here over the next 24 to 36 months. Similarly, I think there will be, mark my words, a mad scramble for Tata Group stocks. Today we've seen a big surge and a big re-rating in Reliance for starters. We've seen a similar thing in Adani Group of stocks, and people haven't participated that much in the Adani Group. Reliance people have participated to a large extent. I think from an industrial house perspective, I think the Tatas, other than all their qualities of governance, all their qualities in terms of transparency, etc., today have added, I think in the last few years, a very sharp commercial focus to a lot of decision making. So, for instance, the fact that Tata Motors could become debt free in now 2.5 years, the fact that capital allocation is going to be extremely critical, free cash flow is going to be the metric. I think there's going to be a mad scramble for Tata stocks. Whether it is, and they, by the way, increasing their holdings in, whether it's Tata Motor DVR, Tata Chemicals, etc. There are insiders buying Tata Power. All this is disclosed. And if you take the global theme, including the fact that the new president in the US is geared towards, alternative fuels, I think the fact that a lot of the thermal portfolios of big energy companies will now remain broadly constant, and they'll move into solar, hydro, wind, etc. means that companies like Tata Power could be huge beneficiaries of this, both in terms of capital flows and in terms of valuation. So Tata Power, whether it's Tata Consumer, it's Tata Motors, Tata Steel, I think big investor fancy could happen in terms of movement, structural movement of interest in that space. So instead of talking industries or stocks, I'm talking about a group, which I think could be a slight variant from the theme that normally has. So I think Tata Group stocks could be, and of course, led by TCS, which has been the sort of best in the pack and the largest in the business. So given all that, I see, and there's an alternative theme I want to talk about. People have been talking about why so many retail and HNI investors are in the market. The fact is, a number of HNI and retail investors were in small businesses that have actually become either obsolete, been bludgeoned out of business, or have actually had to shut shop because economics don't work and consolidation is on. Many of these people, through investments, have started making money and have realized the fact that at the end of the day, individual investment is all about investing in businesses that you could start on your own. So when I invest in a Tata Power or an SBI or a Tata Steel, I'm investing in 3 sectors that I'd like to have probably been there, but I don't have the issues of management. I don't have the issues of entry. I don't have the issues of exit. So in a sense, I'm really investing in businesses which otherwise I might have been interested to be part of, run, etc., etc. So I think a lot more whole-time investors in the market have been created through the pandemic, when people sitting at home have realized and had to develop other skills. I think it's an important aspect, and it's not just that we can rubbish them or wish them away by calling them Robinhood traders or day traders or weak hands. No, some of this may well represent a big undercurrent of a movement of more and more people realizing that the bigger stocks are getting bigger and more invincible. The smaller stocks are getting bludgeoned out. Maybe the way forward is, whether in terms of employment or otherwise, so we can say people may have lost jobs, but there are alternative things that people are doing, whether it's support services for e-commerce, logistics, delivery boys, or becoming investors as a whole. That itself may be an employment which is not captured in terms of job numbers. I think it's important to understand this, to make this differentiation. Numbers may become more visible as these demat accounts and accounts that have been opened up keep increasing, much to everybody's surprise.
So appreciate your time. Have a wonderful year ahead, and certainly hope to see much more of you in 2020.
Thank you very much, and wish everyone, and especially all of you in the studio and your viewers, the very best. All the best.